Chapter 19: Accounting for Income Taxes. Corporations must file income tax returns following the guidelines developed by the Internal Revenue Service, or the IRS. Because GAAP and tax regulations differ in a number of ways, the amounts reported for the following will differ: income tax expense for GAAP and income tax payable for IRC. A temporary difference is the difference between the tax basis of an asset or liability and its reported carrying or book amount in the financial statements that will result in taxable amounts or deductible amounts in future years. A deferred tax liability represents an increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. Deferred tax asset represents the increase in taxes refundable or saved in future years as a result of deductible temporary differences existing at the end of the current year. A deferred tax liability represents the increase in tax payable in future years as a result of taxable temporary differences existing at the end of the current year. A deferred tax asset represents the increases in tax refundable or saved in future years as a result of deductible temporary differences existing at the end of the current year. The deferred tax asset valuation allowance. A company should reduce a deferred tax asset by a valuation allowance if it is more likely than not that it will not realize some portion or all of the deferred tax asset. More likely than not means a level of likelihood of at least slightly more than 50%. The formula to compute income tax expenses: income taxes payable or refundable plus or minus change in deferred income taxes equals income tax expense or benefit. In the income statement or in the notes to the financial statements, a company should disclose the significant components of income tax expense, current and deferred. Taxable temporary differences or deferred tax liabilities, deductible temporary differences, deferred tax asset. Originating temporary difference is the initial difference between the book basis and the tax basis of an asset or liability. Reversing difference occurs when eliminating a temporary difference that originated in prior periods and then removing the related tax effect from the deferred tax account. Permanent differences result from items that 1. Enter into pre-tax financial income but never into taxable income, or 2. Enter into taxable income but never into pre-tax financial income. Permanent differences affect only the period in which they occur. They do not give rise to the future taxable or deductible amounts. There are no deferred tax consequences to be recognized. Future deductible amounts generate deferred tax assets. Future taxable amounts generate deferred tax liabilities. Those are permanent differences. The MACRS depreciation system is used for tax purposes, and the straight line depreciation method is used for financial reporting purposes. A landlord, this is an example of a future taxable amount or liability. A landlord collects some rents in advance. Rents received are taxable in the period when they are received. Future deductible amount or asset. Expenses are incurred in obtaining tax-exempt income. That's a permanent difference. Costs of guarantees and warranties are estimated and accrued for financial reporting purposes. Future deductible amount or a future deductible asset. Installment sales of investments are accounted for by the accrual method for financial reporting purposes and the installment sales method for tax purposes. Future tax amount liability. Proceeds are received from a life insurance company because of the death of a key officer. The company carries a policy on key officers. This would be a permanent difference. Future tax rates. A company must consider presently enacted changes in the tax rate that become effective for a particular future year when determining the tax rate to apply to existing temporary differences. In determining the appropriate enacted tax rate for a given year, companies must use the average tax rate. When a change in the tax rate is enacted, companies should record its effects on the existing deferred income tax accounts immediately. A company reports the effect as an adjustment to income tax expense in the period of the change. Net operating loss, or NOL, equals is a tax deductible expenses exceed taxable when tax deductible expenses exceed taxable revenues. The federal tax law permits taxpayers to use the losses of one year to offset the profits of others. Loss carryback and loss carry forward. Loss carryback can go back 2 years and forward 20 years. Losses must be applied to the earliest year first. Loss carryforward may elect to forego loss carryback and carry forward losses 20 years. Valuation allowance revisited. Whether a company will realize a deferred tax asset depends on whether sufficient taxable income exists or will exist within the carry-forward period. Balance sheet. Income taxes payable and income tax refund receivable are reported as a current liability and current asset, respectively, on the balance sheet. Companies should classify deferred tax accounts as a net non-current amount on the balance sheet. Income statement. Companies are required to report income before income taxes and income tax expense on the income tax. The FASB believes that the asset liability method, sometimes referred to as a liability approach, is the most consistent method for accounting for income taxes. Companies should classify deferred tax assets and liabilities as current and non-current on the balance sheet based on classifications of related assets and liabilities. Similar to GAAP, IFRS uses the asset and liability approach for recording deferred taxes. The classification of deferred taxes under both IFRS and GAAP is always non-current. Under IFRS, an affirmative judgment approach is used by which a deferred tax asset is recognized up to the amount that is probable to be realized. GAAP uses an impairment approach. In this approach, the deferred tax asset is recognized in full. It is then reduced by a valuation account if it is more likely than not that all or a portion of the deferred tax asset will not be realized. IFRS uses an enacted tax rate or substantially enacted tax rate. Substantially enacted means virtually certain. For GAAP, the enacted tax rate must be used. The tax effects related to certain items are reported in equity under IFRS. That is not the case under GAAP, which charges or credits the tax effects to income. GAAP requires companies to assess the likelihood of a certain tax positions being sustainable upon audit. Potential liabilities must be approved and disclosed as the position is more likely than not to be disallowed. Under IFRS, all potential liabilities must be recognized. With respect to measurement, IFRS uses an expected value approach to measure the tax liability, which differs from GAAP. The ISB and the FASB have worked to address some of the differences in accounting for income taxes. Some of the issues under discussion are the term probable under IFRS for recognition of a deferred tax asset, which might be interpreted to mean more likely than not. If the term is changed, the reporting for impairment of deferred tax assets will be essentially the same between GAAP and IFRS. In addition, the FASB recently adopted the IFRS classification approach for deferred tax assets and liabilities. Also, GAAP will likely continue to use the enacted tax rate in computing deferred taxes, except in situations where taxing jurisdiction is not involved. In that case, companies should use IFRS, which is based on enacted rates or substantially enacted tax rates. Finally, the issue of allocation of deferred income taxes to equity for certain transactions under IFRS must be addressed in order to converge with GAAP, which allocates the effects to income. At the time of this printing, deliberations on the income tax project have been suspended indefinitely. A lease is a contractual argument between a lessor and a lessee that gives the lessee the right to use specific property owned by the lessor for a specific period of time. Largest groups of leased equipment involves information technology equipment, transportation such as trucks, aircrafts, and rail, construction, or agriculture. Advantages of leasing for the lessee: 100% financing at fixed rates, protection against obsolescence, flexibility, less costly financing. Advantages: leasing for the lessor often provides profitable interest margins. It can stimulate sales of the lessor's product. It often provides tax benefits to various parties in the lease. It can provide a high residual value to the lessor. Conceptual nature of a lease is: a lease conveys the use of an asset from one party, the lessor, to another, the lessee, without transferring ownership. The various views on capitalization of leases are as follows. Do not capitalize any leased assets. Capitalize leases that are similar to installment purchases. Capitalize all long-term leases. Capitalize firm leases where the penalty for non-performance is substantial. Companies classify lease arrangements as either finance or operating. In either case, companies capitalize all leased assets and liabilities. For a finance lease, the lessee recognizes interest on the lease liability over the life of the lease using the effective interest method and records amortization expense on the right-of-use asset account, generally on a straight-line basis. For an operating lease, the lessee also measures interest expense using the effective interest method. However, the lessee amortizes the right-of-use asset such that the total lease expense is the same from period to period. Only a single lease expense, compromise of interest on the liability of and amortization of the right-of-use asset, is recognized on the income statement. From the lessee's perspective, a lessee should classify a lease based on whether the arrangement is effectively a purchase of the underlying asset. If the lease transfer controls or ownership of the underlying asset to a lessee, then the lease is classified as a finance lease. The lessee takes ownership or consumes a substantial portion of the underlying asset over the lease term. All leases that do not meet any of the financial lease tests are classified as operating leases. Transfer of ownership test: if the lease transfers ownership of the asset to the lessee, it is a finance lease. Purchase option test: the lease purchase option allows the lessee to purchase the property for a price that is significantly lower than the underlying asset's expected fair value at the date of the option becomes exercisable, or the bargain purchase option. If the lease term is 75% or greater of the economic life of the leased asset, the lease meets the lease term test, and finance lease treatment is appropriate. Lease term is generally considered to be the fixed, non-cancelable term of the lease. The bargain renewal option can extend this period. At the commencement of the lease, the difference between the renewal rental and the expected fair rental must be great enough to make exercise the option to renew reasonably certain. Present value test: the lease payments must be fixed payments. Variable payments are based on an index or rate. Guaranteed residual value: payments related to the purchase or termination option that the lessee is reasonably certain to exercise. Discount rate: lessee should compute the present value of the lease payments using the implicit interest rate. This rate at commencement of the lease, which causes the aggregate present value of the lease payments and unguaranteed residual value to be equal to the fair value of the leased asset. In the event that it is impracticable to determine the implicit rate, Delta uses its incremental borrowing rate. If at the end of the lease term the lessor does not have an alternative use for the asset, the lessee classifies the lease as a finance lease. The assumption is that the lessee uses all the benefits from the leased asset, and therefore the lessee has essentially purchased the asset. To illustrate the accounting for a finance lease, The lease classification tests for the lessor are identical to the test used by the lessee to determine classification of a lease as a financing operating lease. For the lessor's part, The lessor has, in substance, transferred control of the right of use asset and therefore has a sales type lease if the lessee takes ownership or consumes a substantial portion of the underlying asset over the lease term. On the other hand, if the lease does not transfer control of the asset over the lease term, the lessor will generally use the operating approach in the accounting for the lease. For a sales type lease, the lessor accounts for the lease in a manner similar to the sale of an asset. The lessor generally records a lease receivable and eliminates the leased asset. The lease receivable for Sterling is shown as lease receivable equals present value of rental payments plus the present value of guaranteed and unguaranteed residual values. The lease meets the criteria for classification as a finance sales type lease because the present value of the lease payments is equal to the fair value of the asset and the lease term is equal to the economic life of the asset. That is, Sterling will consume substantially the entire underlying asset over the lease term. Lessee accounting for operating leases. If a lease does not meet any of the lease classification tests for a finance lease, a lessee should classify it as an operating lease. For leases classified as operating, the lessee records a right of use asset and lease liability at commencement of the lease, similar to the finance lease approach. However, unlike a finance lease, the lessee records the same amount for lease expense each period over the lessee records the same amount for lease expense each period over the lease term. Lessee perspective on guaranteed residual value. The guidelines for accounting for a guaranteed residual value are: if it is probable that the expected residual value is equal to or greater than the guaranteed residual value, the lessee should not include the guaranteed residual value in the computation of the lease liability. If it's less than the expected residual value, the guaranteed residual value is the difference between the expected and guaranteed residual value should be included in computation of the lease liability. A lessee does not include an unguaranteed residual value in the computation of lease liability, whether it is a finance lease or an operating lease. At the end of the lease, the lessee simply returns the lease asset to the lessor without any other payment. In the example before, in this case, there is less certainty that the unguaranteed residual value portion of the asset has been sold, so the lessor recognizes sales revenue and cost of goods sold only for the portion of the asset for which recovery is assured. Both sales revenue and cost of goods sold are reduced by the present value of the unguaranteed residual value. The gross profit computed will be the same amount as when a guaranteed residual value exists for the lessor concerning unguaranteed residual values. To compare a sales type lease with a guaranteed residual value to one with an unguaranteed residual value, assume the facts in the previous example, that is, other lease adjustments. Executory costs are normal expenses associated with owning a leased asset, such as property insurance and property taxes. Executory costs included in the fixed payments required by the lessor should be included in lease payments for the purpose of measuring the lease liability. Payments by the lessee made directly to the taxing authority or insurance provider are considered variable payments and are expensed as incurred. Lease prepayments and incentives. Companies adjust the right of use asset for any lease prepayments, lease incentives, and initial direct costs made prior to or at the commencement date. Lease prepayments made by the lessee increase the right of use asset. Lease incentive payments made by the lessor to the lessee reduce the right of use asset. Initial direct costs incurred by the lessee discussed in the next section increase the right of use asset. Initial direct costs are incremental costs of a lease that would not have been incurred had the lease not been executed. Examples of costs included and excluded for initial direct costs from the lessee and lessor side are Included would be commissions, including payments to employees acting as selling agents, legal fees resulting from execution of the lease, lease documentation preparation costs incurred after the execution of the lease, consideration paid for a guarantee of residual value by an unrelated third party. Excluded are employee salaries, internal engineering costs, legal fees for services rendered before the execution of the lease, negotiating lease term and conditions, advertising, depreciation, costs related to an idle asset. Initial direct costs incurred by the lessee are included in the cost of the right-of-use asset but are not recorded as part of the lease liability. Lesser accounting for initial direct costs depends on the type of lease. For operating leases, a lessor defers the initial direct costs and amortizes them as expenses over the term of the lease. For sales type leases, the lessor expenses initial direct costs at lease commencement in the period in which it recognizes the profit on the sale. Bargain purchase option allows the lessee to purchase the leased property for a future price that is substantially lower than the asset's expected future fair value. If a purchase option exists, the lessee must increase the present value of the lease payments by the present value of the option price. Short-term leases. A lease that at the commencement date has a lease term of 12 months or less. Rather than recording a right-of-use asset and lease liability, lessees may elect to expense the lease payments as incurred. Renewal or termination options that are reasonably certain of exercise by the lessee are included in the lease term. Presentation. Summary of how the lessee reports the information related to the financing operating leases in the financial statement. For a finance lease, the right-of-use asset and lease liability go on the balance sheet, and for the income statement, you include amortization expense and interest expense. But for an operating lease, for the balance sheet, you record a right-of-use asset and lease liability. And income statement, you only record a lease expense. Summary of how lessor reports the information related to sales type and operating leases in the financial statements. For a sales type lease, the lessor records in the balance sheet lease receivable presented separate from other assets, recognize the leased asset, and in the income statement, they record interest revenue and selling profit or loss. For operating leases, they continue to recognize assets subject to operating leases as property, plant, and equipment. In the income statement, they record revenue generally recognized on a straight line basis, depreciation expense on the leased asset. Disclosure. Lessees and lessors must also provide additional qualitative and quantitative disclosures to help financial statements users assess the amount, timing, and certainty of future cash flows. Qualitative disclosures to be provided by both lessees and lessors are summarized in illustrations 21 through 36. Analysis. With the increase in the assets and liabilities, a number of financial metrics used to measure the profitability and solvency of companies will change. Return on assets will decrease, earnings before interest, taxes, and depreciation, and amortization, which likely will require some adjustments as companies amortize right-of-use assets. The debt-to-equity ratio will increase, and the interest coverage ratio will decrease. In a sale-leaseback arrangement, a company, the seller-lessee, transfers an asset to another company, the buyer-lessor, and then leases that asset back from the buyer-lessor. For example, the advantages, the accounting issues in sale-leaseback transactions. The accounting issue is whether the transaction is a sale or a financing. If control has passed from seller to buyer, then a sale has occurred. If control has not passed from seller to buyer, the transaction is recorded as a financing, often referred to as a failed sale. And for a sales transaction, for sales leasebacks, in the sale, gain or loss recognition is appropriate. Darden then records the transaction as follows: increases cash and reduces the carrying value of the asset to zero, referred to as derecognizing the asset. Then they recognize the gain or loss as appropriate, and then they account for the lease back in accordance with lease accounting guidance used in this chapter. Lessors use a third classification, a direct financing lease, in one special situation. This situation occurs when the lessor relinquishes control of the assets of the lessee, but there is also involvement of a third party. The basic difference between a direct financing lease and a sales-type lease relates to the profit on the sale. In a sales-type lease, the profit is recognized immediately. In a direct financing lease, the profit is deferred and recognized over the life of the lease. Both GAAP and IFRS share the same objective of recording leases by lessees and lessors according to their economic substance, that is, according to the definition of assets and liabilities. Much of the terminology for lease accounting in IFRS and GAAP is the same. Both GAAP and IFRS require lessees to recognize a right-of-use asset and related lease liability for leases with terms longer than 1 year. Under both IFRS and GAAP, lessors use the same general criteria consistent with the recent standard on revenue to determine if there is a transfer of control of the underlying asset and if lessors classify leases as a sales type or operating. GAAP and IFRS use the same lessor accounting model for leases classified as sales type or operating. GAAP and IFRS have similar qualitative and quantitative disclosure requirements for lessees and lessors. There is no classification test for lessees under IFRS 16. Thus, lessees account for all leasing using the finance lease method. That is, leases classified as operating leases under GAAP will be accounted for differently compared to IFRS. IFRS allows alternative measurement basis for the right-of-use asset. The revaluation model in accordance with IAS 16 property, plant, and equipment. In addition to the short-term lease exception, IFRS has an additional lessee recognition and measurement exception for leases of assets of low value. IFRS does not include any explicit guidance on collectibility of the lease payments by lessors and amounts necessary to satisfy residual value guarantee. IFRS does not distinguish between sales type and direct financing leases for lessors. Therefore, IFRS 16 permits recognition of selling profit on direct financing leases at lease commencement.